When you log in, you'll find yourself on the Readiness Level Summary page. Here you have two options to open the capitalization table. You will find access in the pull-down menu labeled Tools. The other is in the permanent display box on the right-hand side of the screen. Clicking on either will open up the option for the capitalization table. The capitalization table provides an analysis of the founders' and investors' percentage of ownership, equity dilution, and value of equity in each round of investment. This cash-on-cash analysis provides a sophisticated method for analyzing the optimal number of rounds and amount of investment the venture model will support based upon market current acquisition and initial public offering values. This cap table model is based upon the assumption that investors in each round will expect a 38% equity position. To use the capitalization table, you must first calculate and select a valuation from the venture valuation tool. The cap table provides a general analysis on the effects of step-up or increases in value on equity ownership and cash values between rounds. In reality, step-up values will vary between rounds based upon the performance of the venture and market conditions. Increases in venture value between rounds can be much greater than 2 times the previous rounds. Likewise, the percentage of investor equity of 38% will vary between rounds. This table shows 2 charts, one showing a 2x step up and the other showing a 3x step up in enterprise value. The cap table is designed to do 3 things. 1. Reflect the percentage of equity ownership and cash value of equity with each round of investment. 2. Reflect the increase in equity value associated with a doubling or tripling of venture value between investment rounds. And 3. Identify in which round and at what value the investment is most likely to realize an acquisition or IPO based upon industry sector averages. An acquisition or an IPO can occur obviously at any time. However, it is possible to be too early or to be too late. The objective is to optimize the value of the enterprise at a time of an acquisition or an IPO. The following charts illustrate how to interpret the capitalization table. First, this chart requires no input on your part. This chart shows an initial pre-money value of $1.6 million. The company needs to raise $1 million. This generates a total venture value of $2.6 million after the investment infusion. This investment gives the founders a 62% ownership and the investors a 38% ownership. This slide indicates that there's been a 2 times increase in the value of the company once the $1 million has been used to advance the development of the enterprise. This development is usually in the form of product and market development and setting up the business. This increase in value could be 3, 4, or even 10 times the previous round value. This slide reflects the second round of investment. Notice that the new investment amount is $3.2 million for a 38% equity ownership position for the investor. The founder's ownership percentage has decreased from 62% to 38%, while their equity value has doubled from $1.6 million to $3.2 million. Likewise, the first round investor's ownership has decreased from 38% to 23%, while their equity value has also doubled from $1 million to $2 million. Notice, once again, the value of the venture has doubled from a previous $8.4 million value to $16.8 million after the previous $3.2 million investment has accomplished its intended purpose of growing the company, generating product, and making sales. This slide indicates there's a need for an additional round of financing to continue to grow the company and achieve profitability. In this third round, a $10.5 million investment is made in the venture in exchange for a 38% ownership. Note, again, that the founder's percentage of ownership has gone from 38% to 24%, and their equity value has doubled again from $3.2 million to $6.4 million. Round 1 and 2 investors' equity shares have decreased in percentage and increased in value. Capitalization tables can assist the entrepreneur in forecasting the opportune time to execute an exit event. This usually means selling the company or executing an initial public offering. Timing on this decision is most often based upon market conditions related to when and at what value other companies are being acquired or going public. In this example of an IPO round, the company has again doubled in value from the venture development growth resulting from the previous $10.5 million investment. If this round turned out to be a merger or acquisition round instead of an IPO, a justifiable sales value would be at or above the $54.6 million pre-money valuation. This slide indicates that 38% of ownership was sold to the public for $34.3 million. The results of the public offering leaves the founders with a 15% ownership in the company worth $12.8 million based upon an original investment of less than a few $100,000. Each of the investors made investments that gave them a 38% ownership at the time of their investment. The round 1 investors earned 8 times their original investment. Round 2 investors earned 4 times their original investment. And round 3 investors doubled their money. And now all of the investors have ownership in a publicly traded company with potential for greater growth. If you want to explore the effects of other valuations in the capitalization tables, return to the venture valuation assessment, click on another valuation method, click Save, and click Continue to Capitalization Table. This concludes our discussion on capitalization tables.